Greetings, everybody. This is Jeff Scott, and this is my top-down review for December 31st, 2017. Let me begin by wishing everybody a happy, healthy, and prosperous new year. And as the eminent Mr. Steckler likes to say on the HGSI board, at this time of year, may your best trade of 2017 be your worst in 2018. I titled today, Does the Absence of a Santa Claus Rally Predict a January Swoon? We'll talk a little bit about some of my expectations for the new year. I think I made them pretty clear over the last couple of weeks. I would say Friday was a disappointment as it failed to rally as most of the days over the last week have done in the second half and continued to sell off. It looked like a lot of profit taking as some of the stocks or some of the biggest wins during the year were taken down. I think there's still a lot of confusion around the tax bill, and that may have impacted both tax loss selling and also harvesting of gains. As always, this is for educational purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not licensed by any financial authority to tell you what to do or not to do. I am independent. Anything I talk about or I use, I've paid for and I use in my daily use. And trading involves risk, and you alone are responsible. If I ever talk about options, I would like to add that options carry even higher risk in some people's eyes, and you should be very familiar with what you're doing before you trade options. When I do education programs, I always entitle them to be your own guru. As I learned from Ian Woodward here, my job is not to be a guru for you, but to teach you some tools that you can use to become your own guru. And I've learned from a basis of Can Slim, Improve My Morales and Catcher, Ian Woodward and Ron Brown, John Person, who is a friend now, but I came to him as a customer, mentor, educator, author, great indicators, Van Tharp, Position Size and Money Management, George Lee, my friend and buddy from Northwest Canada, is just a great trader. I've learned a lot from him as well. If I was stuck on a desert isle, I wouldn't need all the programs that I have, but I would need a real-time program, either Thinkorswim, TradeStation, probably prefer both. If you trade futures, I think there's some definite benefits of Genesis. I use HGSI for my analytics, as you will see, supplemented by EdgeRater, and then from time to time I will look at seasonality programs as listed here. The website for HGSI, which I have no financial relationship, is highgrowstock.com. The key points are the free 30-day trial does not require a credit card, and it's worth testing out. If you want to really get power out of it, if you are a new user, I will send you a series of videos. They're getting aged, but they go through each of the buttons and tell you how to use them to make money. And then under investing strategies, there is a number of videos that I put together, and Ron Brown, there's probably hundreds by now of how to use the program. Stock patterns are cyclical. Now, one expects to see a stage of greed and price markup, uncertainty, and then ultimately a fear and a pullback in the market. And each time that we've thought that we've been entering this red circle of sell and that the market was going to come down, we saw another leg to the upside. Well, that was 2017. 2017 is over as of midnight. Will 2018 continue that, where buy and forget will work, or are we going to get into a much more volatile and active market? I think the later probably is the answer. And where you think we are in the cycle really should depend on what you're doing, whether you're being cautious, aggressive, or neutral. And my trades take on a different flavor based upon where I think we are. To say it one more time, we have just finished a year where every time it looked like we were going to roll over, we went up again. We did not have any 5% pullbacks. We are extended in most of the indexes. And ultimately, we always return back to our 50-day moving averages. And those are a long ways away. So at some point, we are going to pull back. And I would look at that not as an opportunity for fear, but rather an opportunity to reset and make money again to the long side. But at some point, we are going to see some of these, quote, excesses ringed out of this market. Speaking of ringing out excesses, this is Friday's sector review, and this is a TradeStation. All it is a closing prices, and broken up by sectors, home builders, materials, energy, and then whether it's XLE or XOP or OIH, financials, XLF, XRE, and so on and so forth. And I look at this just to get an idea where money is going into the market. And it's hard to really say it's going into anywhere. Gold was positive, um, some utilities, but other than that, it's really an ugly market on Friday. And I think you saw that if you were watching the market or looked at your portfolio thereafter. I mean, the major markets always tell the story of what's going on. So let's just look at it in. Well, first thing is you'll notice a lot of red, at least in the E-minis, NQs, YMs, and TFs, and those are all evidence of a market that's under pressure. So let me just open this up. And if we look very quickly, a nice uptrend in the E-mini. The green is the 17-day simple, the yellow is the 50, and the red is the 200. OBV turned down, as did pricing. We had a pretty significant pullback on Friday, closing right around the 17-day moving average. You notice it says high here, which means this is a red candle high, which is frankly the highest of this entire period of time, and we closed down on the day. That's often a one-bar reversal signal. Inside here, hard to see because the white balloon is a PPS sell signal. So this is the E-minis, clearly under pressure. The NASDAQ futures, also in a sell signal, knifed through the 17 days. And, you look at this, you only got 60 points to get down to the 50. And I've been calling for a return for weeks. And maybe we're going to get it this time. Then the question will be, does it hold as support, as it's done most of the time, with a little bit of porosity here, or is this the beginning of a deeper correction? I'm going to expect it to hold, but I recognize that from 65.45 to 63.26 is not even 6%, 5%. So that's a very shallow pullback, and we'll see. Looking at the Dow futures, similar pattern, sitting right above the 17-day with a new PPSL. The Russell ETF, IWM, has already been going sideways for a while, also above the 17 with a new sell signal. So I look at these and I see stalling markets. Perhaps it was an aberration caused by the holiday week, the lower volume on Friday. Perhaps we bounce with some New Year excitement. But right now, you got to call it what you see it, and we've got new sell signals across the major indices sitting above support. The VIX, not really doing much. It's sort of going sideways here around 11.5. That 200-day moving average has been the barrier where even though it pops above it for a day or two, it can't really sustain anything. But notice the VIX is in a PPS buy signal. And then what's been really weak has been the dollar, which continues to knife down further. So I'm not sure we'd see any benefit on the weekly chart, so I'm going to go right back into the slide presentation. And on the weekly charts, you can, you just see the same thing we just saw with big red down bars on the major indexes. And then I do like to look at this during the day and at night, which is all of them on one page, daily, weekly, and monthly by row, and the columns are the E-minis, the NQs, the TFs, the NYSE, and the YMs. And you can see everybody has a big red candle down on Friday. We're starting to see some weakness on the weeklies and the NQs and the TFs, and the monthlies are all a nice uptrend. So will this be a short-term pullback or something more? They have been short-term pullbacks, but that's no guarantee of that is going to continue. What about rates? Actually, I probably should have changed the words and say rates actually fell on the week. Now, this is kind of interesting. We hear about how strong the world economy is, and that we're raising rates and going to ultimately eliminate the QE. And then you see that the rates fell. So that always gets me a little nervous. And you can't see it well here, but they came off on both the 10-year and on the 30-year. And falling rates are good for people that pay dividends, they're not so good for banks. Now, one would expect to see a deterioration in the accumulation distribution lines if we're going to have a major pullback. So whether I look at the mid and small caps, and the white line represents the AD line, the yellow line is the S&P 500, or the Russell 1000 like large cap stocks, we're both at new highs for both for the AD lines with the indexes not far behind. And if I take in dark white the NYSE AD line and I superimpose on it a number of ETFs of major indices, in blue are the TLT or the bonds. And the indexes continue to be near their highs. So yes, Friday was painful. Yes, Friday may be giving us some foreshadowing of what's to come, but we are still closing near the high of the year and without much deterioration in the sector industry ETFs or in the AD line. Breadth remains strong, but not overbought, looking at percentage of stocks above the 200 and above the 40-day. So they've held pretty steady over the last couple of weeks. And the 3-month new high, new low ratio actually pulled off its higher levels. And typically I look at this at its extremes. When I'm up near the top, almost always you see a market reversal. When I'm bouncing off the bottom on this, the market also reverses to the upside. And I didn't really see a McClellan signal. I look for divergences. I look for extreme changes. I look for zero line rejects. At this point, I can't really get a signal out of the McClellan. Looking at some of my breadth indicators in EdgeRater, I see that if you take the 1,500 stocks in the S&P 1,500, and every quarter I redo the stocks on the list because some things come in and out. And so I've redone it. So this date here does not reflect today's date because it's still 12/31. But since there won't be a trading date to the second, I just called the updated indexes or the components January 1st. Of the S&P 1500, if you put a Bollinger Band on each of the 1500 stocks, midline, you have a line, you'd see that half the stocks are above and half are below, and very few stocks are above the Bollinger Band or below. So I would call that a neutral and not giving me a signal. The Hindenburg Omen is a sign of a market that is at risk of having a significant correction. We know that 1 out of 4 times the signals are medium, moderate, or no correction at all, but there has not been a major correction in 50 years that was not preceded by a Hindenburg Omen. And just if you look down here, you see nothing, no red. And so we're not close to a Hindenburg Omen signal at this point. Now, I don't know what's going on, but we noticed a week ago that IWM stopped, not IWM, but the Russell 2000 stopped updating in HGSI. I'll have to ask George about that. So that sort of causes some error messages, and why you see white under, well, there's an error message there. But really, if I look at market tone, we've gone from a lot of green to no green and some red. So clearly the market weakened on Friday, as well as sector strength weakened, where we see in staples and in, what's that? I'm trying to remember which that was. 1, 2, 3, 4, 5, 1, 2. And in financials actually showed some red on Friday. I like to look at indexes that we've put together over the years to give me a clue as to whether or not this market is rolling over. One we look at is the canaries. Here are the list of the canaries. And you notice how we had 1, 2, 3, 4 shots at this resistance here, and we failed 4 times. Yes, there's tails that popped above it, but we closed below this line 4 times in a row. That's pretty strong resistance. And now we've broken below the 50. So I'm nervous here that the canaries perhaps are going to roll over here. And here's the 200-day moving average. It's been a long time since we've come into contact with that. So will we have a quick reversal as we've had the last couple of times that we knifed down to this level, or something worse? I don't know. That's why I said we may be breaking down. And if I look at the index that I put together in June, continue to be consolidating near the highs, certainly has not broken down, although it had a rough day on Friday as well. Know your news and earnings. Not a big news week. In fact, it doesn't look like, well, you do have employment on Friday, the 5th of January, so that'll be useful to see. Um, Other than that, not a lot of news. And earnings are near the end of the season. However, there's still some biggies left. You have PriceSmart, Walgreens, Monsanto, Greenbrier, Constellation Brands is just a couple. This is not an exhaustive list. It's some of the major traded stocks that are due with their dates. And as I put here, for me, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. I like to look at some of the things that I consider important, like ERG, and see how ERG impacted on stocks this year. And it doesn't always work. And clearly, this was a strange year in many ways. ERG stands for earnings per share rank, relative strength rank, and group rank. Not much different than some of the things that you might see if you're a canceling person and look at investors.com. And there's a reason for the overlap of some of the concepts is that when Ian Woodward and George and others got together and developed HGSI, a lot of the key components of canceling were incorporated. So what do we see in these pictures? So here is looking at percent gain by ERG using fundamental data on January 1st, 2017 and looking at the subsequent year. So the first thing that I see, which is weird, is it's kind of flat at a pretty good rate at around 20%. Now, I always ignore the tail and the head because the number of stocks that are being considered here in the light gray are very small. And you could see in the first two buckets to the left, there are, well, in zero, that's interesting, are stocks that did not have all the components in it. But if you look at from one, you had one stock and then six stocks. And zero here, it does not get reflected on this chart. And then you look at the top two buckets, you have 2 and you have 19 stocks. So when you're looking at a total of about 4,000 that are analyzed, 3,000 did not have all the numbers. That meant they were new, or for whatever reason, they did not have all the different data points. We exclude the head and the tail, and you could see here that the average stock was up 15.5% this year. Typically, we see a pattern where higher ERG has higher performance. So that's one thing that makes this year unusual to begin with. We see that the higher earnings per share rank did correlate with higher return, although some of the stocks that had no earnings did well. Relative strength rank, this is weird, on December 31st of 2016, did not impact on outcome in 2017. So this was not high growth from a relative strength, although earnings mattered. Group rank's never perfect because it's a shorter term analysis and it doesn't usually work when I look at it over a long period of time. AD rank, D and E, stocks that were distributing at the end of last year actually outperformed. And then if you look at the HGS boxes, you can see box 6 and 9 perform the best. If we look at the fundamentals from December 1st and look at the last month, you see again a lot of flatness. Interestingly, relative strength rate on the short term and EPS rank on the short term did matter, as did group rank, but this is the lowest group rank. So these were stocks off the bottom. It looks like that must have mattered this month. Stocks that were distributing at the end of November outperformed in December. And box 7, which are the turnaround stocks, had the highest return. Now, the average stock was up 5.3% over the year, but there was a couple of over the month, but you had 2 outliers over 100% return. So did HGSI growth stocks work in 2017? It's an interesting year. I'm pretty vocal about my return. I had a great return. I exceeded the indexes. I trade mostly growth stocks. But looking at this pattern, I would say that it wasn't just growth. Earnings mattered. And I guess if you found stocks that had good earnings, you did well. But it was an interesting year, and perhaps a year where if you didn't look every day at your portfolio, you did better than if you aggressively managed it. There's no rule that says 2018 is going to look like 2017. Market thoughts, holiday week ends with profit taking. Many pundits have been on the air talking about increased volatility over the next few weeks as the tax bill debate has been delayed profit taking. There's many calls for a significant correction, although I would caution you that market structure remains intact. While economic recovery continues to be synchronized across the world, pushing out risk of potential recessions, until you hear that R word, I don't think you're going to see a big market pullback, certainly not more than 8%. And maybe the Fed will overdo it on interest raises, but right now I'm not hearing much about recession. My expectations the market continues higher, but not no, hold on a second, but not without periods of higher volatility with consolidation and pullbacks. Impact on individual stocks may be misled by indices because of sector and industry group rotation. Ultimately, the market continues to climb a wall of worry. However, for this time, there's no signals that might coincide with tops seen in 2007. My goodness, I was half asleep, or maybe I'm drinking too much with the holiday. 2007, 2001, or 87. And let the market behavior dictate your response, not mine or any other pundit's best guesses. We'll do our typical top-down review, and let's get started with that right now. Boy, I wish I was in Florida. I'm up here at a wedding in Baltimore, and it hasn't seen freezing, above freezing in days. So I usually start by going into my trade station and just very quickly looking at some of the signals that I follow. And we'll look at that very quickly. I have a 6-pack of signals that give me an idea of the strength or weakness of the market. I start with the E-minis, and what do I look at? I look at, am I in a buy signal or a sell signal using John Person PPS indicator? I'm in a daily sell, but a weekly and a monthly buy. So we're certainly not at the end of a sell-off. If there's a sell-off, we're at the very beginning. I look at the color of the paint bar, recognizing that blue means indeterminate. Green is should be long or holding, you shouldn't be going short. Red, you should be short or holding, you shouldn't be going long. So blue, and green. So two things here pointing softly to the downside, but not overwhelmingly so. Third thing, am I within the envelopes? Now notice on the daily, I talked about going sideways and getting back in. We're in the envelope. We're above the envelope on the weekly. The next thing I look at are these red dots. These usually occur when you start to get some MACD divergences, and it suggests that perhaps the participation, the strength to push the market up higher might be abating. And we had those disappear on the daily as we pull back. They're still there on the weekly. I look here at the high jump bar. We're down to 66. We've come down a little bit from where we were a couple weeks ago. And our weekly bongo is still green. I look at this, I see a negative market, but I don't necessarily a market that's going to crash or has crashed. So I think this market is certainly deserving of a short pullback. Maybe we're done with that pullback. We shall see. But I don't see something here that says I need to be getting rid of my entire holdings. So if you look back here, just open up this high jump bar a little, this thing here. When I see a high jump bar of 100%, as we saw on the 18th, there is no question that this market was extended. And we've come off of that quite a bit. So that's why I look at the high jump bar and why I pointed it out. I'm not going to go through everything because they all look similar. The YMs, I'll show it to you, just make a comment. New sell signal, high jump bar has come down. If I look at the TFs, really been sideways now for the month of December with the new sell signal. And if I look at the NASDAQ, has already sold off a little bit more. So when I start to put all these things together, it's pretty clear to me that we have a market that is at least pausing and perhaps has a little bit more risk here than we've seen over the last couple of months. If I look at the dollar index, this green dot here, the fact that we crossed below the elders envelope, um, perhaps we're getting to a point where the dollar is going to pause its downfall and bounce, but the dollar is weak with daily, weekly, and monthly sell signals. A weekly bond goes red. I think long-term dollar goes weaker. The VIX bounced on Friday with the markets weaker. It's actually been in a buy signal, went to a weekly buy signal, which we haven't seen one of those in quite some time, going back to 2014. So, no, not 2014, going back to July, I'm sorry. So it'll be interesting to see what happens there. And then if I look at gold, if dollar's weak, then gold is probably something to be in. And I went long gold this week. I think I said I was on my last review. And you have a daily buy, weekly buy, and a monthly buy on gold. So if you can't tell already, I'm not very bullish short term on the market. Doesn't mean I think this market's going to be destroyed. It just means that in the short term, I think that this market's going to be under some pressure. Let's take a look at some of the major components, and then we'll look at some stocks and try not to make this a marathon session today. Being that I'm sitting here in a hotel room with my wife, there are probably some things that we could be doing besides looking at stock charts. All right. Go to top-down view. So I'm ranking stocks by just purely price and volume. I tell you, it's beautiful. We're in Baltimore Harbor. Wedding tonight. We should have some great view of the fireworks. It's just very chilly. You can see gold and silver came to the top this week, which is kind of interesting. You'll notice that the Russell 2000 is up here. This is not correct. The last data was updated was the 12/15. So I added the IWM. So I probably should pull the Russell 2000 out. So let me do that. I'm going to pull it out for now. All right. No. Okay. So gold and silver at the top, gold miners up here, oil. Now those are all things that probably go up when the dollar's weak. Let's take a look at some of the indexes. Now we've already done this, so I don't need to spend a whole lot of time here. And for those who wonder why my charts open up like this, is because I use a 4K monitor when I'm not doing these programs. And so these programs are at a different resolution, or else you'll be complaining. So let's look at the charts. Here, S&P 500, as I talked about on multiple times, at some point we're going to come and visit the 50-day moving average. And just out of curiosity, that 50-day moving average would be about a pullback of 2%. What's the likelihood of us getting down another 2% from here? Yeah, I'd say it's pretty high too. At some point, we're going to touch it. It may be a very bullish event, to tell you the truth. And as you can see, each time we've hit it, did knife through it here in August, but we quickly started a new uptrend. It's been a bullish occurrence. The daily bond goes red, the weekly still green. There's been no Hindenburgs, which we would not expect to see based upon what I showed you earlier. And we're off the top of the high jump bar, but still at the higher part. So I look at this, I see a market that is extended. And at some point it's going to come down and test. It doesn't mean it's all over. This here is the bingo. So this was, I guess, was Tuesday, and this was a down day in the market, at least at some point of the day. And this is the baby out with the bathwater day, where I think this one, I'm just trying to remember, it dropped a lot and then came back during the day. And the bingo is calculated using ARMS index and other things. So that was an intraday And the market recovered before the end of the day. I remember watching it in the morning and it looked like I was going to lose some money. And, I did a couple trades, and then later on it was like, damn, I should have sat on my hands because the market recovered. So that's the S&P 500. Let's look at the Dow Jones Industrial Average. It'll look the same. Distance from here to its 50 would be closer, would be about 3% pullback. That would not be anything significant. The NASDAQ might hurt you short term, especially if you got a lot of margin right now. NASDAQ, it hasn't really rolled over. It's sitting on the 17. It's again a 2% or less pullback would take it down to the 50-day moving average. With the IWM instead of the Russell. The Russell looks strong here, but that's because the Russell has not been updated. So we'll look at the IWM. All right, so where is the IWM? Hold on a second. Did I take the wrong one out? Let's try that again. There's the Russell. And the Russell sideways as well, sitting on top of the 17. So nothing is dead, but I think we're at a point now where it wouldn't surprise me to see a further pullback. And, to be fair, maybe that was just a pullback related to lack of volume, related to a lot of people on vacation, and maybe we bounce. So I don't have an answer or a clear cut. I just have to start, from my mind, for my portfolio, being aware that it would not be out of the ordinary to see a 2 or 3% pullback here down to support. You can see the dollar, it did have a bottoming tail here, but dollar's in pretty much free fall, as we saw earlier. The VIX is off its very lows, but struggles here with the 200-day moving average. A break above that would be good for the VIX and probably bad for my portfolio, since don't have any SVXY shorts right now, which is how I like to play a rising VIX. Notice the VIX had a kahuna, so perhaps we see the VIX rise. Again, subject to the low volume and the volatility of this past week. Gold breaking out here. When we looked at it last week, I commented if it breaks above the 50, I'll be interested. It broke above its 50. Silver now up at the 200. It had a big move on the week. And gold miners have broken above the moving averages as well. Next thing I like to do is I like to go to 07 industry groups. We have 174 groups. Let's look at momentum up. You'll see it's a lower number. 26 to the upside. Apparel, beverages, oils, utilities, tobacco. A lot of non-growth type stocks are up there. Let's look at 2-day down. Electrical power, exploration, communication, pharma, banks, biotech. Some of the groups that have been big leaders of this market had a down week. Now, is this just a 1-week reversal or a 1-day reversal in the case of the electrical power equipment, or have things changed? Let's look at a 5-day up over a longer period of time. To the downside, we have 50 groups, and to the upside, we have 40 groups. So over a longer period of time, the market looks a little healthier. I get a little nervous about making a lot of decisions based upon what may be heavily influenced by one bad day in the market, but you got to play with what you got. If I right click on specialty apparel store, I notice that everything is below the index, which is bothersome. But let's look at a couple of them and see if any of these look viable here. And I'm going to be cautious on what I buy or what I say to buy, because I think this is a market that is in a little bit of a tenuous position. So Burlington's had a big up move. Let's look at when you wanted to buy these things. You wanted to buy it on this day here. You wanted to buy it as it broke above its moving averages with a pocket pivot, a kahuna, OBV turned up, a mobile breakout from a squeeze. As I've said before, I will take these trades even if the weekly bongo is red, as it was here. That would have been the optimal buy point for this. And that's what I kind of look for, is this exact point when I scan through charts. Finish line. The optimal buy point probably was down here where you had a kahuna breaking through the 50, mobile breakout from a squeeze. Could have argued another buy point would have been on this day. I don't know what happened to this price bar, but could have been right here where you had a mobile breakout, a Bible gap up, and a kahuna. Those are the days that I like to find the stocks, and then I put a buy signal stop usually above the high of that day. So finish line's already starting to run, but if you pull and look at I hate where this thing sits. If we look at a weekly chart, a finish line, perhaps it can run all the way up to 21, which is it's a 40% move for where it's at. So maybe you want to be playing with finish line. Children's Place, when did you want to buy that? You want to buy it on this day right here where it had a Bible gap up, a pocket pivot, and a kahuna. I'm not showing you that to beat you up because you didn't buy it. I didn't buy it on that day either. But these are the days that I'm looking to get in, not after a stock has had a big run. Canada Goose, same story. Bible gap up, kahuna, big run. These have all run as far as I'm concerned. Here's another one. I would never have looked at this stock because it's an IPO, never heard of it before. But somewhere in this period right here, you had kahunas, pocket pivots coming out of a squeeze. Chico's these don't look interesting to me at all. So these look good, but not necessarily where I want to be going. Now, I have been talking about ones I've owned. American Eagle Outfitters, AEO. Why did I own American Eagle Outfitters? Move up off the 50 here, and then a big run. Abercrombie and Fitch. Move up off the 50 and a bit of a run, but I've been in that one a little bit longer. You could have been in it back here, which is when I went in around 12, 13. And then Gap is another one that I've been in. Same story over and over again. So this group continues to work. Beverages, so that's not a growth name. When you see beverages up at top, you got to be a little nervous. Constellation Brands, this has been a big winner this year. What a lower left, upper right, tight, all-star stock. Of course, I made money on it and sold it. I would have made my money by sitting on my hands. Bunch of pocket pivots this week. Everything is green. Earnings were out January 5th. Earnings per share growth looks like it might be slowing down a little bit. That always concerns me. But this is only looking out at 2 quarters, and I typically would call up daily graphs and have another resource to validate that. PepsiCo, already running. Ambev. We talked about this on my last video that I did with my seminar attendees, and I said beware of this pattern, and it's already pulled back. This is a tea company that changed their name to Blockchain, and their stock went from 2 to 10. Or 2 to 9.5. I feel bad for the poor soul that bought it at the high price. Diageo, I think they're another alcohol distributor. Not quite as beautiful chart as Constellation Brands, but pretty nice chart. I'd rather be buying it much closer to the 50-day moving average, like down here when MOBO breakouts and pocket pivots and squeezes, etc. All right. Integrated oils, I think it said last week, a good place to be. Petrobras, too many political issues in Brazil for me. Suncor, this gave a great pattern to buy about a week ago. It's breaking out here. Good earnings per share growth, at least for the next quarter. Also slowing down, 2.8% dividend. BP pulled back to the 50 and broke out, 5.7% dividend. You have to check the earnings at a different source. YPF Argentina below Royal Dutch Shell, another nice pattern. 4.8. None of these are necessarily at great new buy points, but they're nice to have one of these in your portfolio. This is the one that I actually took not long ago, and I took it because I love the pattern here of it breaking out, and you could have also taken it down here as well. I got it up here. You had a PSAR reversal and a Kahuna and a MOBO breakout from a squeeze. Pays a small dividend, has great earnings per share growth, and has had a very nice lift. Power generation index, again, not a typical growth name. Growth may not be the story this week. This is a NRG, pays a small dividend. Earnings per share growth is negative. It's a utility. You know, if it showed a Kahuna and a breakout on Monday, I'd have to be interested because it's an uptrend, pull back to the 50 and basing and a squeeze. But, you know, I don't have a whole lot of faith in utilities, although if the market pulls back, these will be a good place to go. Here's one that's pulled back deep and had those signals come in, a Kahuna and a pocket pivot this week. But again, it's a utility. Dynegy, again, give me a growth stock that has this pattern, I'll be all over. Kahuna MOBO breakout from a squeeze, sitting on the 50. This one looks really good, except I don't like the earnings per share growth. If the market is going to pull back, and go through an extended period of weakness, this might be a name to put on your list, Dynegy. A lot of demand on Friday, so some people must think that's going to happen. All right, so I usually go through the top 10. Again, another non-growth name, but a defensive name, tobacco. You buy these for one reason, 4.1% dividend. You know, someday maybe they get into the legal marijuana business and they're growth stocks again, but right now it's more they want to hide themselves and keep selling a product that causes cancer throughout the world. And here is British Tobacco Industries, 4.2%. Hard for me as a cancer doctor to get behind this group, but you buy them for the dividend. Cement, you know, is there going to be an infrastructure spending this coming year? I like Martin Marietta a lot, chart pattern. So here you have a stock that's pulled back, breaks above the 200 here, pocket pivots, lots of green up there. Not a lot of earnings per share growth, but it's turning positive, small dividend. This made my watch list. Look at the group strength. Vulcan Materials, another cement stock. Eagle Materials. MDU Resources, sideways. Number of different stocks here. I liked Martin Marietta. Cable Satellite, again, not your traditional high growth stock groups. I don't know much about this industry, so I look purely at patterns. 2 Kahunas in a row, a MOBO breakout from a squeeze. Don't know anything about this company. Cheap stock, doesn't have enough volume, so I'd probably pass. But this is a pattern that gets my attention if it can break above that 200-day moving average. I don't see anything here I like. You notice I'm not finding a ton of stocks that look viable. 21st Century Fox. You know, this is in takeout mania. Now, I do like the pullback here, the pocket pivot. I'd probably be watching this to see if it breaks out, but nothing comes up to me. Computer hardware and storage. One name here that I've never heard of. That's a $5 stock. Hard for me to get too enthused. But so it's an IPO. It's sitting on the 50, and it had a reversal looking candle there in a Bible gap up. No, excuse me, a green candle low, and it had a out of a squeeze. No, thank you. Maybe it's going somewhere, but not enough of a story. And then lastly, consumer finance. The second one looked interesting to me, Blackhawk. So here's Kiwi, not much in earnings per share growth, pays a 3.2% dividend. Now, I hate the stock pattern. I'll be quite honest with you. Let's look at it on a weekly. Don't like it on the weekly either. But what I do like, and what I think is interesting here, is 3.2% dividend. Big move up on a down day, two kahunas in a row, coming out of a mobile breakout and a squeeze. Earnings are already out. New weekly bond goes green. This looks interesting. I'd rather have something that feels more like an uptrend. So let's look at Blackhawk. It's been sold off hard in October. Pocket pivot, kahuna, squeeze. Similar pattern here of not much earnings per share growth. This one looks interesting as well. So these look interesting from a chart perspective, but I have to recognize I'm looking at them pretty low in their pattern. Then lastly, I'm going to go down to number 11, which is REITs. Yeah, I don't get Redfin. It's a new company. I know some people would say if it takes out its post IPO day high at 34, and goes higher, that nobody's lost money in the stock, and you should be buying it. It's an IPO, not my style. If I look very quickly, so these are not REITs, these are real estate services. There are some REITs that made my list as well. Interestingly, REITs are not on the list here. All right, so if you think I didn't wow you with enthusiasm for great stocks to buy, then you're thinking correctly. I think this is it was a tough week, but it was a tough week with low volume and a holiday, which probably negates some of the toughness. I did find some things that looked interesting. Again, I do a top down, and I also do a bottoms up. On the bottoms up, I might look at stocks that had big volume. Here's that Kiwi. Here's that Videocon D2H holdings that we looked at. I might look at stocks that have pulled back to the 50 with a kahuna. See if any of these were exciting to me. Pent Air, I think, looked okay. So here's a stock. It's kind of loose, but an uptrend on the 50, breaking out off the 50, new kahuna. Two kahunas in a row, pocket pivots, a mobile breakup from a squeeze, and a new weekly bond go buy. It makes money, it pays a small dividend. That's an interesting looking stock. Is it that exciting? No, but it's a pullback to the 50. It's within and a kahuna, and that's what I look for with this scan. Again, loose uptrend, Crown Castle Corporation. This is a REIT. I think they own towers. Great earnings per share growth, pays a big dividend, sitting on the 50 with a kahuna. Mobile breakout from a squeeze. Based upon the pattern, it's likely to go higher from there. It's expensive stock. I also like to look at squeezing with a PSAR reversal to the upside. And I'm interested in this stock, which is High Crush Partners, which is a fracking stock. So if I was to only show you looks like the stock's in a nice uptrend here. Obviously, that's cheating. Stock had been a very expensive stock, sold off hard, but it set a lower here. It's now sitting around on the 50. This will be some resistance, I suspect, to get above the 200-day moving average. It failed up here. Mobile breakout from the squeeze, so why not set a buy limit about 11.5? Looking at the earnings per share growth, looking at the dividend yield, I'd probably be buying stock, not options. But I think High Crush limited partners, and perhaps is Sand the one I'm thinking of? Here's another one of them in the same group. And this one did break out already. Sand, this is Gulf. Never mind, that's not it. Smart Sand, similar pattern, also earnings per share coming into the chart. So that might be something to look at as well. So I do a lot of my scans this way. I like looking at Bible gap ups because a lot of big runs start with Bible gap ups. Ultra Clean Holdings, which is a name that I've been in the past, and then it sold off. It gapped up here because of inclusion in an index. So I'm not going to chase it, but I'm going to put it on my watch list and see what it does. One that recently did the same thing that I had recently had sold was Court. And it gapped up, but really hasn't gone anywhere after being added to the index. So I did go through a lot of stocks from a top down and a bottoms up approach. And these were some of the ones that I liked or I found interesting. Let's rank them by combo. So many of these are stocks that we already looked at. In fact, many of them are. Not a very big list today. Ultra Clean Holdings, China Lodging Group is one that had a nice run. I'm just going to go through each of these very quickly. Nice uptrend, broke out here. Time to have bought it was back here right after the kahuna. Not overextended yet. That's an expensive stock. Eaton Corporation, this is an energy power equipment. Pullback, broke out on Friday. Pocket pivot, bond will turn green. Had a doji after it broke out, so I'm not sure. I'll watch and see what it does, but I thought that was interesting. Here's the Martin Marietta Cement. Here's a good acting biotech, Neurocrine Biosciences. Nice uptrend. Crown Castle we just looked at. Dynegy we talked about. If the market turns, this might be a place to go. Halliburton, this is a stock that's been struggling to get above the 42 range, 44 range, is now broken out. As you can see, it had a lot of resistance in here and it broke out. We'll see if it can stay up there. With $60 a barrel oil, you would think the services stocks are going to rally. I like this, and Schlumberger is the big guys. Ambev is in the beverage group. I picked it. I like the group it was in. Don't really know what to do with this pattern here. But I like the group. Blackhawk we looked at. I think group number 12 was education groups. Here's uptrend, pull back to the 50. A pocket pivot here. I've always struggled with this group, but the pattern looks pretty good. I'm going to watch that. This is a watch list. High crush we already talked about. If I think the market's going to roll over, and if I think big cap tech might be some of the victims, and I have some big tech positions, one way of buffing those losses might be taking a position in the Q shorts. But you can see it's not worked. Every time it's looked like it was time, it runs up and it fails at the 50. So I'm not jumping yet, but that might be one way, or shorting the Qs on a long perspective. Here's a midstream, 8.9% dividend, downtrend, except you could say it's no longer in a downtrend, higher highs, higher lows, pocket pivots, pays an 8.9% dividend. Kahuna, pocket pivot, mobile breakout from a squeeze. Like to see it break above the 200, but Coca-Cola European Partners looked good. Children's Place, it's already running. Tile, interface, pullback, didn't quite make it to the 50, but weekly bond goes green, coming out of a squeeze with a pocket pivot and a kahuna. This is one of my favorite chart patterns that I see. I'd rather be buying it at 24 than at 25, but I may not get that choice. Here's a refiner. Nice uptrend here, pays a 22% dividend. When you see that, There should be fireworks going off in your head. Why is it such a high dividend? What's wrong? What's the story? It's got an extra letter in the symbol, so I have to do research on this to understand it. Here's another MLP moving up, does not pay a dividend. Here's an oil exploration play, RSP Permian. Here's a REIT, Retail Properties of America. Hard for me to buy these because of the shopping centers going down, and what are you going to do with the big box stores? But is it done going down? I don't know. It sold off from 17 down to 12. Seems to have turned into a weekly uptrend. Daily is broken above resistance. Pays a 4.9% dividend. Here's another MLP dividend payer at 4.1% with great earnings coming into the stock. A pocket pivot. Not my typical buy stocks. A lot of defensive plays. Here's Smart Sand. This is like High Crush Limited Partners without the dividend. Rockwell Automation. This is one of my favorites. Nice uptrend. It was supposed to be acquired. The acquisition fell through. It pulled back a little bit, but it's sitting right above the 50. I'd like to see some new momentum come in before I get excited. Endeavor is a refiner, pays a small dividend but huge growth rate. Refiners had a very good year. And then another oil exploration stock, which was Carrizo. Great earnings per share coming in. Not my typical exciting week of great stocks to buy. I think this is what you see when you look at what's setting up after a low volume holiday week, especially with the sell-off. I guess I haven't looked at this, so it's kind of like don't ask before you know the answer. But I do a bunch of scans, and I scan for green candle lows, and green candle lows would be a reversal to the upside. So if I look at green candle lows, we had 7 on Friday. A red candle high would be a reversal to the downside. We had 351 out of 2,500 stocks had a red candle high. That means on Friday we had a 1-bar reversal to the downside, 50 to 1 versus upside. That doesn't portend good results for the market in the coming week. However, based upon the fact that we were dealing with a holiday market with low volume, year-end issues of tax loss harvesting and profit taking may make that a little bit harder to understand what it means. On that note, I'm going to wish everybody a happy new year, safe and happy and healthy one. Be careful tonight if you're out on the roads, and we'll talk with you all next year. Bye, everybody.